Welcome to our CFP exam prep discussion on convertible bonds. Today we're diving deep into this fascinating hybrid security that combines features of both bonds and stocks. Understanding convertible bonds is crucial for the CFP exam, and many candidates often misunderstand their complex nature. Let's break down convertible bonds fundamentally. A convertible bond starts its life as a regular bond, paying interest to bondholders, but with a special feature that allows conversion into a predetermined number of the issuing company's common shares. This conversion ratio tells you how many shares you'll receive for each bond. The market value of a convertible bond consists of two main components. First, there's the straight bond value, which is the present value of all future interest payments plus the principal. Second, there's the conversion premium, which represents the additional value from the potential to convert into equity. Think of it as having a regular bond plus a call option on the company's stock. Here's a practical example that often appears in the CFP exam. Let's say a company issues a $1,000 convertible bond with a conversion ratio of 20. This means each bond can be converted into 20 shares of common stock. If the current stock price is $40, the conversion value would be $800. Since this is less than the bond's par value, it wouldn't make sense to convert immediately. However, if the stock price rises to $60, the conversion value becomes $1,200, making conversion attractive. A common mistake students make on the exam is forgetting about the convertible bond's floor value. The bond will never trade below its straight bond value unless there's significant credit risk. This provides downside protection while maintaining upside potential through the equity conversion feature. Another critical concept is the conversion premium. It's the difference between the convertible bond's market price and its conversion value, expressed as a percentage. Test takers often struggle with calculating this correctly. If a convertible bond trades at $1,100 and has a conversion value of $1,000, the conversion premium is 10%. Understanding market conditions' impact on convertible bonds is essential. When interest rates rise, the straight bond component's value typically falls, but if the underlying stock performs well, the conversion value might offset this decline. This relationship frequently appears in exam questions designed to test your analytical skills. Let's talk about a crucial exam trap. Many students mistakenly believe that conversion always occurs when the stock price exceeds the conversion price. However, other factors like remaining interest payments and dividend rates on the common stock also influence the optimal conversion decision. For portfolio management questions, remember that convertible bonds typically offer lower yields than straight bonds from the same issuer. This reflects the value of the conversion option. However, they usually provide higher income than the underlying stock's dividend yield. This risk-return profile makes them attractive for conservative investors seeking potential equity participation. When studying for the exam, focus on understanding the relationships between the convertible bonds components. Practice calculating conversion ratios, conversion values, and premiums. Be prepared to analyze scenarios where market conditions change and determine whether conversion would be beneficial. Remember to consider the issuer's perspective too. Companies often issue convertible bonds to lower their borrowing costs compared to straight bonds and to delay equity dilution. This broader understanding will help you tackle the more challenging exam questions that test multiple concepts simultaneously.